Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we're back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Chris Verrone. Chris is a partner at Strategas and heads the firm's macro and technical research effort. Chris, how are you doing this morning?
Ross, it's great to be here. Thanks for having me.
Yeah, thrilled to talk to you. Let's start high level. You've been writing for a little bit about how rates are driving market leadership. What does that mean, and what is leadership right now in the market?
Yeah, I think it's a great question. And we'll kind of start with the first part of that, just with respect to rates. And it just strikes me, we've been on the road a lot over the last month. We were in Europe last week. We were in Texas and Boston the week prior. And every time you're in a room and you go around and you ask clients, what do they see as the biggest risk for equity markets over the next month or 3 months or 6 months? The answer has always been people worried about bond yield running away to 5% or 550. We just don't see it. And we don't see it because it's not on the charts. And when you look at these yields, 10-year yields, for example, we're now 6, 7, 8 months into this pattern of lower highs in yields. They were 502 back in October. The most recent peak was 475, then 465, then 455. And here we sit today, kind of post CPI, post PPI, and yields are hovering in this 4.25 neighborhood. So the question I would be asking, if yields up is no longer the right call, what does yields down mean for the leadership fabric of this market? And, one of the things we've seen recently are some of these groups that were really penalized by higher yields over the last year or two. I'm thinking about stuff like biotech or solar, actually start to show some life. We've seen it with the real estate stocks here as well. Now, the question we have over time, Roth, and I think it's a very important one, at what point would lower yields no longer be stimulative? At what point would it actually start to reflect a material slowing of the economy? And again, that's where I think we can let the leadership of this market help answer that. I like the fact that the real defensive groups, like, say, consumer staples, really still do not have a bid. I would get more worried about the yield message on the economy if you began to see some of these defensives really take hold. Just hasn't happened yet.
Yeah, it hasn't. And outside of utilities, which, narratively is now apparently an AI play, as you mentioned, those yield proxies are really not showing any signs of life. Stepping outside of the U.S., you've written on China, some of the strength in Europe. What's the most interesting thing to you happening overseas right now?
I think at a minimum, we ought to be open to the idea that there's some strategic low maybe beginning to take shape in China. And we've done a lot of work over the last couple of weeks, really at the urging of clients. We went back and we looked at how, what was the character of how the S&P bottomed in late 2008, early 2009? And can we draw any parallels or similarities with some of the price action we're seeing in China today? And I do think there are some similarities, the first of which is the apocalyptic sentiment that really accompanied both lows back in March '09 here domestically, and over the last 4 or 5 months in China. I think the other parallel that we've seen recently is what I would describe the emergence of some early cycle leadership in that part of the world. For example, even though, say, U.S. consumer discretionary maybe has stalled here or become more of a mid-cycle leadership setup here, if you look at Asia, developing Asia, China in particular, the discretionary stocks, which are a signature of an early cycle advance, have actually really started to turn up and have started to outperform. So there's some parallels here. At the end of the day, we'll let the market determine what the best path forward here is. But I think at a minimum, it would be silly not to even entertain the idea that something strategic or more durable might be taking shape there.
All right. Last question. Let's just do kind of a grab bag here. What is one thing or one indicator that you think is being under discussed as a either diagnostic tool for the current market or as an indicator of what might be to come? Gold, dollar, credit spreads, anything's fair, but something that you're watching that you think is under discussed.
I would kind of answer this through the lens of, the question that we get in almost every meeting. We're recording this. I'm in Milwaukee. I spent the last couple of days visiting with, our great partners at PWM here. And the questions that were coming up in meetings were, when do you think the Fed will cut rates? And it comes up in every meeting, in all of our travels. And I would answer the question really this way. The only Fed speaker you should care about, the only Fed commentary you should care about, is what the 2-year yield is saying every day. 2-year yields, as we sit here, are let's call it 460, 465. What's that, 90 basis points, 75 basis points below where Fed funds is. Even after the cut from the ECB last week, German two-year yields are still something like 75 basis points below German two-year yields. I think the bond market is continuing to tell you that these central banks want to cut. I think gold has told us all year these central banks want to cut. And the big trick in this business is differentiating between what should happen versus what could happen. Should the Fed cut rates? I don't know. Maybe, maybe not. I would lean probably not. Economy seems decent. Financial conditions seems pretty easy. But could they cut rates? Absolutely. And that, I think, is the message of the bond market. And I think that's the message to gold here.
Well, Chris, this has been really insightful, really great stuff, especially after a Fed meeting, after a CPI print, a lot of stuff that our clients are thinking about. So thank you so much for the time, and we'll hope to get to talk again soon.
Ross, always a pleasure. Talk to you guys soon. Take care.